Only mode.
Good afternoon, everyone, and welcome to Nova 401k Associates webinar, Common 401k Plan Errors. This will be presented today by Steve Best. He is a VP here at Nova. If you have any questions throughout the presentation, please type them in the questions box, and Steve will answer them throughout and then at the end of the presentation. If you'd like to view this recording later or have someone in your office that was not able to attend, or would ever just like to refer back to this information, the recording will be made available on our Nova YouTube channel. Just go to youtube.com, type in Nova 401k Associates, and you can find our channel. We will have this webinar as well as other past webinars available for view. Steve, we are ready to go.
All right, good afternoon, everyone, and welcome to our webinar on common 401k plan errors. This is kind of a compilation of errors that we've seen in our business practice, as well as some of the more common errors that the IRS also identifies in its 12 most common error checklist that's available online. So we've tried to give the best of both worlds here. First, a quick disclaimer, nothing in the presentation is intended to be legal advice, and if you need legal advice, you need to consult a qualified professional like an attorney or an accountant, especially if you need tax advice, an accountant would be in order. Also, if you need CPA credit, Nova's provider number is 009820. You need to have registered individually for this webinar, be present for the entire thing, and then return an evaluation form after the webinar is over. Then we'll send you a certification of your credit within a week. Quick overview of some of the objectives. We'd like to make sure everybody understands how to identify who's a fiduciary to the 401k plan that you're dealing with. Also, to identify some of the more common administrative errors that relate to these plans, how to avoid them, and then also there are corrections that are mandated and or suggested by the IRS for some of these errors as well. Also like to start with a quick overview of the service model that we use here at Nova 401k. Really, we have what's called an unbundled model of service for your plan. So there are different service providers who specialize in different things, and we feel like this is the best way to bring the greatest level of expertise to your plan. So in any 401k arrangement, there really are 4 roles to be played. The one that's not on this chart is you as the sponsor or the employer company. But the other 3 service providers include your investment provider. And again, this could be, we work with many, as many as 10 or 15, from John Hancock, Mass Mutual, Empower, a whole variety of Voya. But they're the ones that provide your investment platform. You send in the contributions that you deduct from employee payroll to them. They invest it in the mutual funds, provide the 1-800 number and internet access so people can see how their investments are doing, make changes, things of that nature. And they also do the record keeping. They keep the different money sources separated out. You've got your deferral, your employer match, maybe safe harbor rollover. They track all these different sources separately as is required by law. Then we have Nova 401k Associates. We're in the middle TPA column, so that stands for third-party administration firm. And we're simply a consulting firm that handles all of your IRS compliance, from the 4 or 5 different mandatory non-discrimination tests to maintaining your legal plan document. Our group also helps in certain cases with loan and distribution review. And we also prepare a signature-ready Form 5500, which is the annual filing that has to be submitted to the Department of Labor every year. And then finally, your investment advisor is also involved, because neither our firm or your investment provider can provide specific investment advice to your employees. So if somebody really needs help constructing their portfolio or advice about how to invest, they can go to your investment advisor, and they also help with enrolling your participants from time to time and doing annual reviews, annual fiduciary reviews on the investments within your plan. So together, this is a total service model that you're operating under. So why is this webinar important? What we found is that operational plan failures are a lot more common than investment-related losses. You may receive a lot of emails from, a lot of it's spam, but there's a lot of commentary and worry about lawsuits related to investments. And really, in the mid to small plan market, you rarely see these types of losses and lawsuits specifically. But you do see a lot of money being coughed up by employers because of operational problems. And we'll discuss a little bit what that's about. But there are substantial penalties and fees to correct some of these administrative errors. And the fiduciaries of the plan bear personal liability for fiduciary breaches and losses. Now, not everything we will discuss in this webinar is considered a fiduciary breach, which is a lot more serious. They're just operational problems. But the bottom line is there's a lot of money that can be cost to the company if there are mistakes made in the plan. And this chart kind of shows that the Department of Labor, as well as the IRS, are quite active in collecting restorative payments from plan sponsors due to errors. They have some fiduciary correction programs that collect fees and various other types of penalties that can be assessed. In fact, the IRS specifically and Department of Labor can assess penalties separately. So, for example, the 5500 forms, the Schedule SSAs, a few of these required forms that have to be filed have penalties associated with them when they're late. And not only that, the two agencies just increased their penalties like tenfold. If you look at the new penalties compared to the old ones, they're substantially higher. So again, we just want to keep you out of trouble and have the plan operate smoothly. Now, should there be an error, just so you know, we're going to talk about some of the specific ones here in a moment, but there is a process to correcting mistakes, and you can either self-correct some mistakes that are eligible for self-correction, meaning you don't have to do a formal filing with the IRS in order to fix the problem. There are more serious issues that if you need to correct them can be corrected, but it would involve a voluntary correction program filing, which is a formal filing with the IRS, which also comes with additional fees. And then there's also, if you get caught outright, like you didn't submit voluntarily or self-correct a problem, the audit cap program with the IRS is one that you would enter if they actually audit you and discover a problem that you haven't already previously fixed. So just to give you some idea, if you did have to submit a DCP filing with the IRS, there is a filing fee, and depending on the size of your plan, the amount of money that's in it, the fee varies. Most plans probably fall into the middle category. So to fix a problem and just to pay the IRS fee is $3,000, and that doesn't include the cost for NOVA to complete any corrective calculations, or if the company had to make up contributions to employees, it doesn't include that amount either. So again, this is why this is important. We want to talk about some of these common errors so you can avoid them and avoid any of these types of fees. So who is a fiduciary? ERISA, which is the law that governs a lot of the qualified plan administration, names three. We're not going to concentrate on the first two because they're investment related, the 321 and the 338. This presentation will be more about the 316, plan administrator fiduciary. So, who is a fiduciary of the plan? Basically, any individual or entity who exercises any kind of discretionary control over the plan administration or over the plan assets or renders investment advice is going to be a fiduciary. All right, and that can include quite a few different types of people. As we see here, that includes your investment advisor, who was on the previous chart, the trustees to the plan. Again, the trustees have the most control over the plan and are typically named in your legal plan document. The investment managers, that are at Voya and John Hancock and whoever you use. If you have an administrative committee, all the committee members who are making decisions about the plans would be fiduciaries. The people that govern the plan administrators, which are the people that do the day-to-day work at your office regarding the plan, whether it's approving loans and distributions or signing off on 5500s, things of that nature, those people are fiduciaries. And anyone who hires or fires any of the above people is also fiduciary. So that's typically going to be the owners of the company or the primary decision makers at the employer. Okay, so specifically though, the 316 fiduciary is an individual who is a plan administrator. Okay, that person can be named in your legal plan document, but typically is not, right? There's no specific person. And if there's no person named in the plan document, then essentially the plan sponsor, your employer company, is the 316 fiduciary. Okay, this is the person responsible for managing the daily operations of the plan. So it is going to be whoever's delegated this duty at your company. All right. So some of the duties of the plan administrator or the 316 administrator involve distributing annual notices. There's a summary plan description, an SPD that has to go out to participants. Typically approving loans and distributions is one of the functions. Depending on who your investment provider is, they may handle approving loans and distributions automatically, but a lot require a signature from the employer in order to do it. So I'm not going to go through all of these, but one of the more important ones obviously is enrolling newly eligible employees, right? As they get hired, sending in the contributions to the investment company, making sure that the annual 5500 is filed. Again, NOVA prepares a lot of these items for you, but we don't necessarily distribute them and we don't sign them and submit them. We give you instructions on how to do that, right? So getting into some of the more common mistakes that we see. The first one is failure to amend your legal plan document for current law changes. All right, so every so often the IRS and Congress change the laws governing 401k plans and require certain amendments be made to the plan documents. Sometimes these can be in the form of interim amendments. So, every 5 to 6 years, the IRS releases new template documents. So they're just fill in the blank checkbox type documents that contain all the latest legal changes. And then in between major document restatements, or when they release these template documents every 5 to 6 years, if there are law changes in between the major document restatements, these are called interim amendments, and sometimes plans need to amend for those. Now, this is something that NOVA does keep track of and prepare for you. So we do prepare the restatements when necessary, whenever new documents become available. If there are interim amendments, we keep track of that and make sure that we, let you know when one needs to be signed. Sometimes they require your signature, sometimes they don't. But it's approximately, again, every 6 years for a major restatement. We have a new restatement period coming up. So within the next 1 to 2 years, you're going to see a lot of emails coming from our documents department about what we call now the tri-cycle restatement. It's just a brand new template document. And it doesn't matter whether you're with NOVA or any other provider that handles 401k plans, everyone in the country is going to have to amend to these new template documents. And so we're in the process even now of sending out emails to you, letting you know, hey, this is a required restatement, and giving whoever's authorized to sign on behalf of your company the instructions on what to do. So it's basically a mandatory update. All right, so be on the lookout for those emails. They're not all going out at once. We're sort of segmenting them, and so within the next 2 years, everything has to be done and signed. So as an example, if you had an interim amendment, and one of the ones in 2008 was the 415 regulations amendment, but if you had an attorney or somebody, or even us, that sent out a 415 regulation amendment and indicated that it needed to be adopted by December 31st of '08, but the amendment somehow got misplaced or unexecuted in somebody's drawer and wasn't discovered until later, then there's a penalty for that. And this is actually one of the more common VCP filings that we run across. Usually with new clients that we pick up, we find that they never executed their prior document, or they missed an amendment somewhere along the line. And what happens is we have to go and file under the IRS VCP program as a late amender, which again has those fees involved. I mean, it's going to be a $3,000 fee just to the IRS. Then we have to prepare the amendment, so we have our costs as well. And so it's very important to just keep an eye out for these emails that we send to make sure everything's executed on time. All right. Another type of common error is failure to sign up all of your affiliated employers. So these template documents have to have executed participation agreements for every different EIN or company that you pay people out of. So many companies are in a related group, and maybe there's a parent subsidiary situation going on. Every EIN has to execute a participation agreement in order to be eligible to participate in your plan. And failure to do so means that that particular entity, you might have had them participating in your plan, but if they weren't legally signed up, we have a problem. The plan document, you have to follow the terms of your plan document in practice. So, you have to follow what's in there. If somebody wasn't signed up, then they're not eligible to participate. So for example, some of these related groups are called control groups. And generally, if multiple companies are in one control group, they should be participating in one plan. All right, so what is a control group? There are two types. We've got parent subsidiary control groups, which is when one company owns 80% or more of another company. We also have a brother-sister control group, which is when the same 5 or fewer common owners own at least 80% or more than one company. Could be 2, 4, 5, whatever. But if you've got the same 5 or fewer common owners owning more than 80%, then you're in what's called a related group, and the IRS views that group, even though there's many companies, they view it as one company for purposes of participating in a plan. All right, so you can't have a control group, generally speaking, with 5 or 6 plans out there, all different plans. So again, how do we avoid, these types of problems, amending on a timely basis, signing up all your employers? Just read the correspondence from NOVA. Obviously, we send out lots of emails. There's a lot of follow-up emails from our system. If we sent an amendment to you, there are usually reminders that go out weekly that a document needs to be signed. It's usually going to be a DocuSign email, right? So that's all electronically done now. Just make sure you're adopting those amendments by the deadlines that are in the instructions within the emails. Also, again, if you've got multiple companies that are, again, above this 80% threshold, we just need to make sure that they're signed up for the plan if you actually have them participating. Again, you can't really exclude companies that are in the related group for the most part either. So, if you know of some companies that are out there that are not actually participating in your plan, give us a call. All right. Also, if there's ever going to be an acquisition, right, that's either coming up, let us know. It's much better for us to know about an acquisition before it happens than afterwards, because we can, consult with you on what the options are. If you're acquiring a company that has another plan, or maybe they don't have another plan and you want them to participate in yours, all these types of issues are very important when you're buying or selling companies.
Hey, Steve, we did have one question come in.
Okay.
What if sister companies have separate plans, but are evaluated as one when compliance testing is performed. Is this okay with the IRS?
Yeah, so I mean, I'm giving you the general idea here that if you have multiple companies, they should all be in one plan. Can a control group of companies have separate plans? Maybe, but they have to pass some specialized testing. Again, and that's something that NOVA can do. There's usually additional fees involved with that, but if each plan in a control group can pass some special testing, then it may be possible to maintain separate plans. We do have some clients like that. But a lot of times what we find is members of a control group don't even realize that either they're in the control group or that they have multiple plans, and no one's keeping an eye on doing this testing on all the plans. So, that's the main issue with having separate plans. There needs to be one compliance entity sort of doing the testing at a high level. And if that's occurring, then great. But we find many clients are in that situation, but not doing the testing. Oops, hold on, let me see. Okay, so failing to follow the provisions of your plan document. Again, each of your plans is governed by a legal document, and it indicates what the terms of the plan are, what the eligibility waiting period is, what your vesting schedule is, and you're required to follow all of these written terms that are in the legal plan document in your daily practice. And not doing so creates potential disqualification issues or some of these operational failures, which we're going to be talking about. So one of the more common ones is not following your plan's definition of compensation. So what compensation that you're supposed to use for implementing employee deductions, the compensation definition that you use to compute your matching formulas if you're making a match, all of this is defined in your plan documents. And many times employers are using a different definition in payroll for calculating contributions than what the plan document says. And that results in participants receiving incorrect allocations, okay? So, most of our NOVA plan documents define compensation as total gross W-2 pay, all right? So excluding bonuses, commissions, overtime may be permitted, but it does require some special testing, and that exclusion needs to be in your document. If your document says that your definition is gross pay and you're excluding bonuses, there's a problem. There's a disconnect there between the document and what you're doing, and that's going to require a correction. All right, so if you're not sure what your definition of compensation is in your plan document, definitely call your NOVA account manager to find out what it is and make sure that it's lining up to what your payroll system is doing. So here's just a little example. If we've got a company that adopts a matching formula and their payroll system is set to calculate the match using base pay, which excludes overtime and bonuses, but their document is indicating that it's based on total gross pay, you've got a problem. That what's going to happen here is we, NOVA, would have to do some calculation that bases the contributions on what the document says, and to the extent that you've underpaid people, then the company's going to have to cough up the difference plus earnings. And it might be correctable, self-correctable, or you might have to do a VCP filing as well, depending on how serious the problem is. But again, that can be an expensive issue depending on the number of people and the type of error that's involved when you're not computing your contributions on the right definition of pay. So again, how do we avoid this? We need to know what's in our legal plan document. What is the definition of pay? And then compare that to your payroll system and some of the deduction codes that are in there, and make sure that it lines up, that it's the same. Again, your NOVA account manager can help you determine, what your document says if you're not sure how to read it. And then also make sure that the personnel who handle payroll are properly trained on what those definitions are as well. If you're going to have turnover, anything like that, you need to make sure people are properly trained. So another extremely common error is failure to apply your plan's initial weighting. So, if you get this wrong, you can let people in either early or you can let them in late. But just keep in mind, the plan, again, this legal plan document is what defines what the waiting period for eligibility is in your plan. It doesn't matter what your administrative policy is. It doesn't matter what your offer letters say. None of that. That has no weight at all on the 401k plan. And so we do find that sometimes employers are not letting people in a timely manner. The reverse can happen too. We've seen employers let people in early or let people in late. Okay, and in each situation, the fix is a little bit different. So as an example, if you have a company that has no age or service requirement for entry into the plan, but holds an individual out for 6 months, then what do we do about that? Steve in this case would have to be made whole by the employer for the missed employee and employer contributions to the plan, right? If he should have been eligible on day one and you held him out for 6 months, you find out what the 6 months worth of pay is, and we'll have to figure out what deferral election he might have made or come up with a reasonable estimate based on what everybody else is doing. But the company's going to have to cough up money plus earnings for the missed contributions because he was delayed or held out of the plan too long. So just so you know, I like to go over how do you actually compute and determine when people are eligible. And we're not going to go over every circumstance, but one of the more common waiting periods is the maximum period. So the longest any 401k plan can hold someone out is for 1 year and age 21 as requirements with a minimum of 2 entry dates. Okay, those are usually going to be the first day of the plan year and maybe the 7th month. Okay, a certain number of hours can be required in order to accrue the 1 year of service. Typically, that's going to be a minimum of 1,000, but it can't be more than 1,000. The maximum age requirement is 21, and the initial computation period for figuring out this 1 year wait is the 12-month anniversary date from the original date of hire, and then that can typically shift to the calendar year. So I know that it's a lot to take in right now. So let's look at a visual example. Let's say, so this is a 1 year wait with semi-annual entry dates, very common in a lot of our plans. If you have an employee who is hired on 6/1 of 19, you go to the 12-month anniversary date from the original date of hire, not all the rehire dates if you have rehires. So from the original date of hire, you go to the 12-month anniversary date and you ask the question, I think everybody can see the pointer too down here. We ask the question, did they work 1,000 hours in this period? And you can see it's crossing calendar years, right? If the answer is yes, they would come in on the next available entry date. So the 12-month anniversary date is 6/1/2020, and the entry date is 7/1/2020. So they should be offered the plan for pay periods after 7/1/2020. What if this answer is no? This person worked like 500 hours, right? Do they get credited 1 year of service? No, they do not, because you have to work 1,000 hours in the initial computation period. The initial computation period is set by law. It's the 12-month anniversary date from the original date of hire. But to make it a little bit easier in following periods, so we have a guy that worked person that worked 500 hours. The second computation period switches to the calendar year. That makes it easier to track, right? You can imagine if you had 100 employees and you had to track all these oddball periods and figure out the hours on into the future, right? It would be almost impossible. So the second computation period for somebody that doesn't work 1,000 hours in the first one becomes the calendar year. You ask the same question in the next calendar year for this person, which is 2020. Did they work 1,000 hours in that period? And if the answer is yes, then they come in on 1/1/2020, or they become eligible. So you credit They don't become eligible the day they work the 1,000th hour. They do become eligible on the anniversary dates, but that's how the 1-year wait works. Okay. Now, shorter periods are okay. We have a lot of plans that either have immediate eligibility or 3-month wait, 6-month wait. Shorter than 1 year is perfectly fine. Those shorter periods work on an elapsed time basis. So you don't look at hours. Let's say you have a 6-month wait. Again, you start with the original date of hire. You go to the 6-month anniversary date. And if the person's employed on the 6-month anniversary date, they get the whole 6-month period. They could have come and gone 10 times in the first 6 months. Are they employed on their original hire date, and are they employed on the 6-month anniversary date? That's all you have to ask. They get service spanning for the intervening period. Okay, so just keep that in mind. These types of waiting periods and plans are not very effective for keeping part-time employees out, just so you know, right? Because it has nothing to do with the number of hours they work. All right. So improperly, talking about part-time employees, improperly excluding classes of employees is another very common error, right? So if a sponsor is excluding hourly employees from their 401k plan, then the document has to be written and say that you exclude hourly employees, all right? Also, excluding employees, there's a limit to how many you can exclude. And there's certain tests that look at that we run for you. So it's not like you can exclude everyone. I mean, typically you can exclude about 30% of your non-highly compensated employees as a maximum. So if you're excluding, let's say the hourlies were 50% of your population, you're not going to be able to exclude them all, no matter what your document says. Okay. But certainly if you're in practice excluding anyone and it's not in your document, there's a problem. Similarly, we have a lot of employers that like to exclude part-time or seasonal employees. Just keep in mind that the IRS doesn't like service-based exclusion language in a document. Okay, and even if it's possible, it needs to be in your document. You can't just exclude part-timers. I know it's very common to do it on the health and welfare side, but in a 401k plan, generally, part-timers are not excluded. And the IRS views, these seasonal or these service-based type terms, part-time, seasonal, temporary, to be a circumvention of the maximum 1-year wait, because you can have part-timers that work 1,000 hours in many years, and you've excluded them by class, but they met the 1-year requirement, right? So they look at this as a way to sort of get around the maximum waiting period that they put in all plans. So how do we avoid these errors? You need to be aware of what the waiting period is in your plan. This is one of the most important items in your plan document to know how to calculate and have your HR people know how to do, because NOVA cannot monitor your eligibility and determine when people should be offered the plan, because we don't know when you're hiring people on a real-time basis. And so understand what your waiting period is. Is it 3 months, 6 months? What are your entry dates? Also, are you excluding anyone, right? If it's a 3-month requirement, am I excluding part-timers? Again, that has to be in your document if you're going to try to do that. And just as good business practice, in case the IRS comes in and audits you, we would suggest that you collect all, like if you're offering someone the plan, collect even the 0 declinations, like I decline to participate, right? And have them fill out the form with a 0 or something, the enrollment form, and send it back to you so you can keep it on file, because this is one of the things that IRS looks at in an audit. Were you offering your plan? Can you prove to me that you were offering your plan in a timely manner to your employees? So.
We have a couple questions.
Okay.
What if an employee chooses not to participate at the time of eligibility, but decides to participate later?
Good question. Yeah, and that's fine. So once you've met the eligibility, the initial waiting period, the initial eligibility requirement, Somebody doesn't have to participate, right? You just have to offer them the plan. But once they're eligible on into the future. Now, your plan does have entry dates. Let's say it's the semi-annual one. So in that example, on 7/1, the individual who made the 1-year requirement decides, I don't want to participate. They can come into the plan later. They can tell you 6 months later, hey, I want to participate, but they do have to wait for another one of the entry dates, essentially. You know, it's like the entry dates and deferral modification dates that are also in your plan document are there for your administrative ease. And every document can be different. You can allow your participants to modify their elections anywhere from payroll by payroll to semi-annual, right? Just to make life easier for you in terms of how many times people can make changes. So depending on your document, if your document said, I'm only going to allow people to make changes twice a year, the person, so 7/1 of 2020, they said no, they have to wait till at least, 1/1 of 2021, and then you'd implement them or let them back into the plan, right? If it was payroll by payroll, the minute somebody decided after 7/1, okay, 3 months later I changed my mind, then let them in on the next available payroll. So it kind of just depends on your plan.
Okay, next question. What do we use the subsequent computation periods for? Since once an employee is eligible, they do not need to maintain that 1,000 hours to still be eligible.
That's true. So that's a good point. Again, the subsequent computation period is only if somebody, let me go back to that example. If somebody did not make the 1-year wait on the first computation period. So the example I was giving was somebody here in this period only worked 500 hours or 900 hours. So they didn't get to 1,000 hours in the initial computation period. The subsequent period is for those types of individuals. They didn't make it at the beginning. So now to see if they become eligible in some future period, I look at the calendar year. I don't look at this period that crosses calendar years.
Okay, next question. What happens if someone reaches 1,000 hours before the 1-year anniversary? Do they become eligible?
Okay, so I kind of mentioned that, but I went fast. So you do not get credited a year of service the minute you work your 1,000th hour. You get credited your 1 year of service at the end of the computation period or on the anniversary date. Okay, so again, in that example, somebody 7/1 of 19 was the higher date, let's say, or 6 of 19 was the higher date. They don't actually get credit a year of service till 6 of 2020. That, the 12-month anniversary date. That's when they get credited 1 year of service, and then they still have to wait until the next entry date.
What about if you just cannot get someone to turn in their form?
Again, there's no guarantee you're going to be able to, it's not like you can force people to send in their paperwork. To be able to prove to the IRS that you're letting people in on time, it's great to, if you can't get declination forms, at least keep a roster of who you offered the plan to, like a worksheet, or if you want to copy emails into their personnel file showing that, hey, I sent you the paperwork, or I sent you an email that gave you the instruction on how to enroll, right? And it saves somewhere so you can point to that and go, look, this is when we offer them the plan, right? That's the whole idea there. The more you can do in that regard, the better. Plan audits are not that common, but we're seeing a lot more of them. And again, since we have so many clients, we help our clients with these audits. And this is a question that comes up all the time with the IRS, just so you know.
And one more question. If an employee is part-time and works less than 1,000 hours per year, is that okay? Or is it an ongoing calculation of hours after their 1 year?
So part-time, again, unless you've specifically put in your document that you're excluding part-timers, you should not even think about part-time in any way, shape, or form. If you've got a 1 year wait, If a part-timer works 1,000 hours in a particular computation period, they're in. You should allow them to participate. Okay, so you can exclude certain classes, but it's got to be in your document, and then there's a limit to how many people you can actually exclude. So, so let's keep moving along. I don't want to run out of time here. We do get a lot of questions about, how to handle rehires, right? And it's a little bit easier than you might think. So, if a formerly eligible employee ever had a single vested dollar in your plan, then he or she never loses their prior year service credits. It doesn't matter how long they've been gone. Okay, so it's very rare for anyone, a rehire, to ever lose their prior year service credits. There is one circumstance where they do. If they never, like they were previously eligible, but they never had any money of any kind in your plan, and they've been gone for 5 years, then they restart. Okay, they lose their prior service credits. Okay, but that's pretty rare, right, to happen. It can happen, and I would just say contact us if you've got a situation that's like that. But the general rule is, if your rehire was previously eligible for your plan, offer them the plan immediately upon rehire. They don't have to wait for the 1-year wait or the 3-month wait or the entry date. The minute they walk in the door, offer them the plan. Okay. Oh my goodness, went too far. Must have hit the end button. Sorry about this. Where are we? Apologize, folks. Okay. So there can be some confusion too about, you've got how do I compute initial eligibility periods and vesting. Like we mentioned before, your initial eligibility period has to always be credited from the original date of hire, okay? And like we saw before, sometimes it'll, that first computation period is almost always going to cross a plan year if it's a 1-year wait, so forth. For service for vesting, right, like how much of the employer contribution can I take when I leave the company, okay? That's always computed on a plan year basis, and most plan years are calendar year, okay? 2 different computation periods. Again, we do track, the vesting we track for you based on your plan's provisions and the hours that someone works when you report them on your census. Our system calculates the vesting for you. This is more just so you understand there is a bit of a difference. Okay. Also, once you become eligible, there can be additional requirements in order to receive the employer contribution, the match, that you allocate as an employer. Some plans can require that somebody work 1,000 hours in a plan year or be employed on the last day of the plan year in order to get the contribution. Okay, so don't confuse that with initial eligibility. So somebody is eligible, and they have additional requirements to get the match. All right. Those types of requirements that I just mentioned, requiring 1,000 hours and the last day of employment on the plan year, that doesn't work well with payroll by payroll. You'll never see those in our documents. I won't go into the boring details about why it doesn't work well. But those types of requirements are typically if you're doing an annual match. So I'm going to contribute and have NOVA calculate the match on the whole plan year, and I'm not doing it payroll by payroll. So loans are very common in plans. We do see a lot of different loan failures as well. There are certain rules that relate to loans. Again, loans are not taxable distributions, and people have to repay them, but they do have to follow certain rules so that they are not taxable distributions. All right. There's a maximum dollar amount that people can take. There's also certain repayment schedules and timing that has to be made on the payments people make back. A lot of times a loan will be taken, but repayments are not started on time in payroll. That's a very common mistake, okay? The key here is that if you've missed payments on a loan, like the loan didn't get started on time and so forth, then the loan becomes delinquent and has to be corrected. Otherwise, it'll get defaulted. So a loan that has become delinquent has to be, corrected or brought current, for the missed loan repayments by the quarter following the quarter in which the first payment is missed, or the quarter in which the loan became delinquent. So you got about 2 quarters to fix it, right? If it's not cured or fixed within this time frame, then it has to be defaulted by IRS regulation. What that means is that the loan is considered a taxable distribution. The participant will get a 1099 showing it as taxable income, right? Which can, create a problem for your participants, and that they owe more tax at the end of the year. Some investment providers can have to be told to default a loan. Others are going to do this automatically for you. Just depends on who your investment company is. So what are some of the methods to fix a loan that becomes delinquent, right? You can cure it or fix it before the cure period ends. And that means you either have to make up the missed loan repayments. The participant can pay off the loan in full, which is probably not going to be one of the ways they do it, or you have to refinance the loan. Okay, so because since it missed payments, the loan will never be able to be paid off by the maturity date in the original loan documents, right? If you had a 5-year loan and you missed 6 months worth of payments, it's not going to go to zero by the end of 5 years unless you do something. And one of those ways to do something is to re-amortize it or refinance it. There is a cost to that. Obviously, there's our distribution group has to do extra work, and usually there's an extra $100, but you can fix it that way. If you fix it after the cure period ends, it used to be that the IRS would require a voluntary compliance filing. Now you can actually self-correct this problem, and it's essentially the same as whether you're in the cure period or not, right? You would refinance it, or you would catch up the missed loan payments, and then you don't have to do a formal filing, all right? So again, quick example, but we have an administrator that sets up the loan payments as a deduction, and the participant does not make arrangements to make the payments. So months go by, the administrator realizes that the payments are not being deducted, and what's the issue here? We've got to default the loan. It'll be a taxable distribution, right? We may be able to refinance it, but again, that can be a problem, right? If you missed a year's worth of repayments and you had a 4-year loan, now you got to squeeze all the repayments into 4 years instead of 5, and the payment goes way up, which could be a hardship for the employee, but it can be fixed. There is a maximum limit. It doesn't matter if you've got $1 million balance, right? Typically, it's the lesser of 50% of the vested account balance, or $50,000. So you can have $1 million balance. That doesn't mean you can take 50% or $500,000. You're still limited to $50,000. So in this example, if we have somebody that accidentally took a $60,000 loan, then this excess amount over $50,000 would have to be considered a taxable distribution again. So when you're breaking these rules, typically involves taxation of the loan. Again, how do we avoid some of these loan problems? Almost all of your investment providers also record keep the loans and track them. And if loans become delinquent, most have reports that get sent to you as an administrator indicating, that loan payments have not been received, and then listing the loans that seem to be delinquent, right? So keep an eye out on all of your message center emails that you get from your investment providers. They'll let you know if there are people you need to look at. Also, it's good to periodically look at who has an outstanding loan, let's say John Hancock, Voya, whoever, and compare that to your payroll records. Now, you may have some loans for people that are terminated that are not necessarily problems, but if you have an active employee that shows that they have a loan at John Hancock, and you don't have a loan deduction set up in your payroll system, that's a problem. That's a problem to be fixed. So, and generally, you only want to allow one loan at a time. That's how Nova does draft our policies. Just so you know, we try to make it simpler that way for you. That way you don't have to be tracking multiple loans from different participants. Another very common error that we have to fix, and we do a lot of this type of correction work, for employee contributions and loan repayments. So basically employee contributions, those contributions have to be sent in within a certain amount of time from the pay date. For small plans, the DOL created a safe harbor time frame. You have 7 business days after the pay date to get the money from your general ledger into your investment company. All right. This doesn't apply to the employer match contributions that you may be making, but all the employee money, the DOL does not want you as a company hanging on to employees' money for more than a certain amount of time. And if we go beyond that time frame, Nova and you have to fix the problem. These are late, what they call late contributions, and they are monitored by the Department of Labor. They're also reportable on your Form 5500. There's a blank on there that says, did you have late contributions? And if you did, the Department of Labor may audit your plan if that question is marked yes. Okay, so we definitely want to be fixing them. The bad thing is here, the cost of the correction is more than what you normally are going to have to pay, because what happens is if they're late, you as a company have to pay a certain amount of interest back to the employees in the plan. And typically that interest isn't that much, you know, if something isn't really, really late. But quite often our firm has to charge $300 or $400 to do a $50 fix, which doesn't make sense, but there's just a lot more work in actually what we do than the amount of money you have to cough into the plan. So large plans have a different standard. So a large plan is one in which there are more than 100 eligible employees. Okay. So if you're a large plan, the standard is as soon as administratively possible, but not longer than the 15th day of the month following the pay date. You can ignore that second bullet. The Department of Labor thinks it's as soon as administratively possible. Now, what does that mean? That means that they are going to look, if the DOL comes into audit, they're going to look at your other business practices. If you're sending in your federal withholding within like 4 days, then your standard may be 4 days. It may be 2 days. I mean, it's just, you know, they're going to look at all your other business practices. You know, how quickly did you send all of the other payrolls, and was there an outlier? Like, I got all my payrolls in 2 days, and here's one that's 2 weeks, right? Your standard is going to be 2 days with the DOL. Okay, so it's a big DOL audit issue. Your CPAs, if you're a large plan, your plan has to be audited by an independent CPA firm. They also look for this, and so, you know, just keep it in mind that, you know, you need to get that money in as soon as possible. So again, we have an example where we have a company that fails to deposit the contributions for a particular pay period for 3 months. Then what do we have to do? Nova has to compute the lost earnings on those late contributions. You as a sponsor will have to report them on the 5500, and you may also have to pay an additional excise tax penalty depending on the amount of the lost earnings. So, all right, so again, in order to avoid this, determine what your applicable deadline is. Are you a small plan or are you a large plan? All right. Then set up procedures to ensure that deposits are made, you know, by either the 7th business day or, you know, as soon as administratively possible. I would say that I've seen the Department of Labor under these as soon as administratively possible standard give you anywhere from 3 to 5 days max. If it's beyond that, they're considering it late, just so you know, it's a big plan. So if you have multiple payroll runs, make sure you check them all. And the thing is consistency. If you're a large plan, If you're getting all of your payrolls in 3 days, then get them all in 3 days. Don't have one 3 days, then another one 5 days, another one 6 days. They're probably going to pick the lowest standard. So just be consistent. We also have to correct quite a few errors that involve depositing money into the wrong source, the source of money. So at your investment provider, there are different line items. You've got your employee deferral line item that has to be segregated from your Roth, the matching line item. You've got a bucket for profit sharing, for safe harbor. It just depends on the type of plan you have. But since the vesting for all of these money sources can be different and the distribution requirements are different, they have to be record kept by Hancock and Voy and all those guys separately, all right? And we do find that companies sometimes can deposit money into the wrong source, and then we have to spend time fixing that for you, which again, we have to charge for, all right? So for example, we have a company that amends a plan to go from a safe harbor match, or it amends it into a safe harbor match, but it was making a regular match before, a discretionary match. But somebody keeps depositing the safe harbor contributions into the old discretionary matching source, all right? So safe harbor contributions are 100% vested immediately, whereas discretionary matching contributions are subject to the plan's vesting schedule. So we've got a problem that we would have to go in and fix because people could be paid out incorrectly, right? If somebody leaves before we notice this, then that means that they probably got paid out incorrectly, and there's even more corrections to be made. It's just time and money, basically, to fix these problems. In payroll, it's important to understand there are limits on the employee contributions as well as the employer match, and we'll get into the match in a minute. But for 2021, the maximum any one person under the age of 50 can deposit in a year is $19,500. Okay, if you're 50 or older at any time this year, you can put in an extra $6,500. Okay, this applies to both the sum of the Roth and the pre-tax deferral. So Roth is an after-tax deduction, and pre-tax is pre-tax. But you would add up all the contributions under each one of those deductions, and they're limited to these limits. Okay. The match has a separate limit. If you're not making a matching contribution, then don't worry about this. But if you ever do, or you are making one, this is something you need to keep in mind. Because there is a compensation limit in 401k plans, a maximum amount that we can count. And that amount is $290,000 for 2021, okay? It effectively creates a cap or a maximum amount of match that any one participant can also get. It's better to just look at an example. If we have a plan, for example, that has a discretionary matching formula of 50 cents on the dollar on the first 6, then that means that the maximum match for this year that any one person can get is $8,700. And we get to that by taking the 290,000 times basically 6% times 0.5. So basically 3% of 290, okay, is the limit, okay? And if you go above that, we end up having to forfeit the excess amounts. So this typically is going to occur with people that make more than 290. If you got somebody making 500,000, you don't keep matching 3% on 500,000. It's capped at 290. All right, so we're almost out of time here. I'll try to make this quick. So just another example. Actually, I'll skip this one. This is just a different formula showing the same thing. This is a 4% formula. You take 4% of 290, you come up with, but this is for safe harbor plans. If you've got a safe harbor, basic matching safe harbor plan, no person should ever get more than $11,600 in match for this year. And so you need to set up your caps in payroll, your maximum amounts, so that they cut off when people hit these dollar amounts on the match. That's how you prevent this problem, which is kind of what I just mentioned here. So moving along, since we're running out of time. Again, there's a failure to distribute participant notices. There are quite a few notices that have to be sent out every year, and a lot of these notices can be sent out by your investment provider, but many fall to you as the plan administrator to send out. The summary plan description, which is a layman's explanation of what's in the legal plan document, has to go out to all participants as they become eligible, and it's not normally part of the normal enrollment materials from your investment provider. Okay, you've also got fee disclosure notices. Those are typically sent out by the Hancocks and Voyas of the world. If you're a safe harbor plan, there's an annual safe harbor notice that has to go out. Again, NOVA does, if we produce these notices, like the summary plan description and the safe harbor notice, we do send them out with correspondence when they're due to let you know that you need to send these out, but they are part of your responsibility. Okay. If you have a forfeiture account, again, the non-vested piece of the match that the company retains. So somebody leaves and they're not 100% vested in the match. What do you do with these forfeitures that you took from the person? They go into a holding account at your investment provider, and you can then use them to either offset routine discretionary plan expenses, or you can use them to offset your ongoing employer contributions. But the one thing you'd never want to happen is have checks go back to the employer. Okay, so you never want to request a check back. That's a prohibited transaction subject to penalty. All right, so it cannot leave the plan. So we've discussed a lot of different mistakes and responsibilities that you as the 316 administrators have. So what if you need help? We do have some solutions for you. You can actually hire a third-party 316 administrator, and those people are fiduciaries and would be experts in retirement plan administration. And you might be asking, well, isn't NOVA 316? We're not, because we actually just prepare everything for you. We're like a CPA that goes, here's your tax return, but you're signing it, right? So you sign your plan document, you approve loan and distributions. We may review them. We prepare a 5500, but you sign it. We prepare testing, but again, it's up to you to review it, right? So NOVA is not a fiduciary to your plan. If you want to hire one, a separate 316 who would actually sit as an employee in your office. So you're head of HR, but you're not an expert in 401k plans. Let me go hire somebody to help me as one of my employees. You can do that. What we have here, basically I've discussed this. Basically what NOVA is doing is we're providing certain ministerial functions, but we're not fiduciaries. You want to hire a 316, we do have a separate company. It's called Administrative Fiduciary Services, and they can handle, we can send out some of these slides so you can see some of the bullets, but these are some of your responsibilities. There's quite a few here. We've got different levels of service, but it is a separate company because this company will be a fiduciary. So if for some reason a 5500 is late or a distribution goes out wrong and they're responsible for reviewing it, they cut the check. Your organization is insulated from that kind of fiduciary liability. And so if you're interested in additional help or you don't want to deal with as much of the day-to-day administration, just contact Araceli at this company, Araceli Valdez, and she'll be happy to tell you more about the services and help you out. So I don't know if we have some questions. I know we're over. We might be able to take a couple.
Yeah, we can get through. We have received quite a few, but we can get through a couple. If we're not able to get to everyone's question, we can definitely follow up with an email. So everyone's question will be answered either today or we can send the emails tomorrow. I do want to let everyone know that a PDF copy of today's presentation, as well as a link to the recording, will be sent to all attendees tomorrow. So you don't need to reach out individually for those. So again, a PDF copy of the presentation, as well as the link to the recording, will be sent to everyone tomorrow. Also, if you wanted to receive a CE certificate for Texas CPA credit, there will be a survey at the end of the presentation. So right when you close out, it will automatically launch. So please be on the lookout for that. Your certificate will be sent to you via email within 1 week. If for any reason you don't receive a certificate, you can always email us at webinars@nova401k.com and we'll be happy to help you out. All right, question. Normally, the company contribution is safe harbor. The up to 2% profit sharing has vesting. So I'll enter profit sharing as a regular match.
Well, again, when you're depositing money at John Hancock, it's important to keep the money going into the right source. So at your investment provider, you'll have a safe harbor source. So you want your safe harbor matched, let's say, going into the safe harbor matching source. And if you're also making a profit sharing on top of it, that's discretionary, that has to go into the discretionary profit sharing source. You don't want to commingle those two sources, otherwise there's a problem that we need to fix. And again, the whole idea here is that one source is 100% vested and the other one may not be. And if you leave them commingled, as people get paid out, they're getting paid out incorrectly.
Is there a maximum employment eligibility time frame? For example, can my company require an employee to have worked for the company for 5 years before they are eligible to participate?
No. So as I showed in the prior chart, the maximum waiting period for all 401k plans and retirement plans is 1 year of service, computed as I indicated earlier. And you've got to have a minimum of 2 entry dates. So typically it's on a calendar year, it's going to be 1/1 and 7/1, and then a 1 year wait is the most you can require. And age 21 is the highest age you can require.
Are we required to continue to notify employees of eligibility if they didn't participate initially after notification?
Good question. The answer is no. If somebody declines initial participation, it's up to them to ask to be enrolled in the plan. That being said, it's usually good if again, your investment advisor can sometimes help with the annual enrollment meetings or education, because I mean, it is a good thing to kind of connect with people and get them into the plan for multiple reasons. But there's no legal requirement.
For declinations of participation, does the plan sponsor keep those on file or does the financial advisor?
That's a plan sponsor, because when the IRS comes to audit, they're going to look at your records. And ultimately, that's part of your responsibility, like enrolling people on time and being able to prove that you offered the plan to people on time is generally the responsibility of the employer.
All right, we'll get through like 2, 3 more. So those terminated before becoming eligible and then are rehired, restart their eligibility period?
Repeat that one more time.
So those terminated before eligibility, so I guess before meeting the eligibility requirements, and then are rehired, do they restart their eligibility period?
Okay, that one can be complicated. If you didn't meet the eligibility requirement at all, then typically you're gonna have to requalify. But what can happen is some people can have met the waiting period, but they missed the entry date. You know what I mean? So I got my 3 months, but I terminated before I hit my entry date. That type of an individual, if they rehire after their entry date again, then you should let them in immediately upon rehire. So, but if they never met the 3 months or the 1 year, then yeah, they have to meet it at some point in order to get in.
What if you want to change the eligibility for the employer match?
Well, generally, you have the same initial waiting period or initial eligibility requirement for both your 401k and your match. Can they be different? Yes, but it's really not recommended. Okay, if you're thinking you might want to do that, give me a call. I had Jason's number on the back side of this slide. I'm Steve Vest, so it's the same number, but 9311 is the last 4 digits. And I'm just Steve at Nova 401k. But you don't want those. Trust me, there's many reasons you don't want those eligibility requirements being different, but they can be legally. It's got to be in your document, however.
Are loan payments taxable, or are they considered non-taxable?
So the loan, when it's taken, is not a taxable distribution, but when you're setting up your loan payments that the participant makes in your payroll system, those are after-tax deductions. Okay, so I don't know if that answers the question, but the loan itself, I take $10,000. It's not taxable if I follow the rules. But when you set up the loan repayments, make sure the loan repayments are after tax that are being sent back. So.
And Steve, you can tell me when to, cut off.
I think, well, I mean, we're way over. So if anybody else has additional questions, we're happy to answer them. Again, just email me at steve@nova401k.com or Andrea, and we can respond in an email.
Yeah, if I did not get to your question, I have a list of the questions that we weren't able to address, so I can send those over to Steve, and he can reach out to the email address that we received them from. So yeah,
okay.
There were quite a few.
All right, well, we appreciate everybody's time this afternoon. Sorry we went over, but hopefully it was useful for you. Again, just contact us if you have any questions.
All right, and again, just a quick reminder, there will be the survey that's about to pop up. If you do need Texas CPA credit, please go ahead and fill that out. We'll email you your certificate, and we will send everyone that attended an email tomorrow with a PDF copy of the presentation, as well as a link to the recording on our Nova YouTube channel. Please feel free to visit Nova's website at www.nova401k.com. To see what future webinars. We have a couple coming up that are pretty good. We have one that goes over in-depth in loans and distributions, as well as a few others. And also visit our YouTube channel. We have recordings from past webinars that are also nice and on demand. So again, if anyone has any questions, please reach out to Steve or webinars@nova401k.com. We appreciate you taking time out of your day to attend. Everybody have a great day.